Well, hello. My name is Anthony Sicaro. I'm founder and president of Providence Financial and Insurance Services, located in the heart of the San Fernando Valley in Woodland Hills, California. I'm also host of the Providence Financial Retirement Show, which airs every Saturday at 2 o'clock p.m. on AM 870 KRL Lay the Answer. And this video is going to be an update regarding the yield curve, or the flat curve, if you will. And what is the yield curve and what does it mean to you? And primarily this video is for my clients, so if you're a client of mine, you know how much I appreciate your business. Thank you for your business. Thank you for your loyalty and your trust. You know I don't take it lightly. If you're not a client of mine, you're welcome to watch this video. If you have any questions, please don't hesitate to call, and one of our advisors can answer your question, or I could certainly answer your question as well. And you can find our contact information right through our website at providencefinancialinc.com. So what is the yield curve? Well, the Federal Reserve made a move last week during their Federal Open Market Committee that I think shocked a lot of people. It was not a move that was anticipated, not a move that was expected, and a move that is being widely questioned. Matter of fact, I've listened to a lot of things, I've read a lot of things, and I haven't found anyone who can really explain why they did what they did. So I want to talk about what they did, then I want to talk about what it affects you, and just throw out, a couple of ideas and thoughts that I have, whether they're valid or not. My goal is just to communicate with you what I'm thinking, since I'm managing your portfolios. So we need to define some terms. First of all, I think we need to define yield, and then we need to define yield curve. What is the yield curve? Well, when we talk about yield and we talk about yield curve, specifically regarding yield curve, what we're talking about is the 3-month treasury bond versus the 10-year treasury bond. Those are the 2 points that we're looking at when we talk about yield curve. So that's specifically with regards to bond. When we talk about yield, a yield is the relationship of the dividend or interest to the particular investment. And as the investment fluctuates in value, the income from the investment stays the same, but the yield changes. And I don't want to get into a lot of details of that. I've got other videos on that you can watch on YouTube that get more into detail, but just for a very quick 45-second idea or explanation. Let's say you have an investment that's $100, okay? And let's say that investment is paying $5 per share. $5 per share. Right now it's at $100. Well, that's 5%, right? So the yield on that $100 is 5%. Well, let's say that the $100 share grows to $200. Well, it's still going to pay $5 a share, but now all of a sudden, because the price of the investment doubled, and because the $5 per share remains consistent, stays the same, the yield is now not 5%. The yield is now 2.5%. So the price went up, the yield came down. Right? And the reverse is also true. If you have that $100 a share and it's paying $5 a share, that's 5%. If that $100 per share of any investment dropped to $50 a share, well, the $5 keeps coming in, but that's now a 10% yield, right? $5 divided by the current price of $50 is 10%. So now you have a 10% yield. So what happens is when you have the price of an investment, the price is going to fluctuate, the income is going to generally remain consistent, and the yield's going to fluctuate as well too. But here's the deal, the yield fluctuates opposite of the price. So just in our example, if the price came down, the yield went up, and if the price goes up, the yield comes down. So it's important to understand that relationship, okay? And that's as far as I want to go into it as far as this is concerned. If you follow me on YouTube, then you can access our other videos and I get into more detail about that. So that's what yield. So when we talk about a yield curve, what we're doing is we're talking about the difference between a short-term yield and a long-term yield. Generally speaking, historically speaking, you want and investors expect longer-term investments to pay more than shorter-term investments, right? If you have a choice of a 3-month CD or a 3-year CD, which do you think you're going to pay more? Of course, the 3-year CD. If you have a choice of a 1-year bond or a 10-year bond, which would you expect to pay more interest? The 10-year bond. Why? Because you're locking up your money for a longer period of time. So you expect that the longer the investment, the more you're going to earn in the way of interest rates. And that's just the way that it's supposed to be. That's a normal interest rate environment. And therefore, when you look at a yield curve, I'm not going to draw it out, but when you look at a yield curve, it's supposed to go like this, right? It's supposed to be shorter term here, longer term here, so that the longer you go out, the steeper the curve. So a 1-year bond might pay a percentage, a 3-year bond is a little higher, a 10-year bond is a little higher than that, and a 30-year bond is a lot higher than that. So it curves up. You've got a natural curve up because the longer the bond, the more interest it's supposed to pay. And that's what we talk about when we talk about yield curve. So what's happened though is the yield curve has now for 2 days in a row gone flat. What that means is that the 3-month treasury bond, okay, is actually paying more than the 10-year treasury bond. And specifically, when I looked this up before this video, the 3-month bond is getting 2.45%, whereas the 10-year bond is getting 2.41%. So if you bought a 3-month bond, you'd get 2.45. If you bought a 10-year bond, you'd get 2.41. So let me ask you, what makes more sense? Would you lock your money up for 10 years for less of a return than you could get if you locked your money up only for 3 months? Of course not. That'd be ridiculous. But people are doing it. That and that's very telling. And that's what an inverted yield curve is a yield curve that instead of goes like this, what it's doing is it's staying flat. And in this situation, it's going just a little bit down at the very end. People are actually buying 10-year bonds that are paying less interest than if they buy a 3-year bond. So the question is, why would they do this? Well, we're going to come back to that question in a second. I want to answer that question before this video is over. But I want to talk about the Fed's involvement before we do that. And it's important to understand that the Federal Reserve can control the short-term interest rates. When you hear the Federal Reserve raising interest rates, they're raising the short-term rate. And if they raise the short-term rate, then the long-term rate's supposed to follow with it. The Federal Reserve doesn't control the long-term rate, but if the short-term rate's going to pay 2.5, then people expect to make maybe 3 on the 10-year. So it's going to go up. If the Federal Reserve raises the short-term rate to 3, then people would expect to make 3.5 or 4 longer term. So the Federal Reserve directly controls the short-term rate, but they indirectly control the long-term rate. At least that's supposed to be what's happening. So the Federal Reserve has raised interest rates now 9 times in the last 2 years. I believe that's where we are, 9, maybe 10. But they've raised them a lot of times in the last couple of years, the short-term rate. And what's happening is the long-term rates raise a little bit. As a matter of fact, the long-term rate towards the end of last year got up to over 3. So at least there was a 0.5% difference there. But the Federal Reserve last week made a couple of announcements that brought long-term rates down. Everyone was really expecting the Federal Reserve to raise interest rates in March last week. And the first announcement they made is that they're not going to raise the interest rates. And I found that very curious. There's really no good reason why they're not raising the interest rates. They're blaming it on the stock market. Some of the turmoil that we saw back in November and December were certainly a direct result of interest rates rising, but for reasons that we'll talk about in a minute, I don't think that necessarily holds water. But the second reason, the second reason that actually the first reason is because of the stock market. That's why they're not raising interest rates. But the second thing they did, sorry, I lost my train of thought. But the second thing they did, other than saying that they were going to hold interest rates steady and not raise them. The second thing they did is they said that now they're actually going to quit selling bonds back into the marketplace. You remember from 2008, 2009, 2008, actually, all the way until I believe it was 2014, maybe 2015, the Federal Reserve was printing money, right? They were buying bonds and putting money into the marketplace, and they called this quantitative easing, but they were putting capital out there and artificially inflating the market. Well, that's put our debt, we've gone from $7 or $8 trillion of debt to $21 trillion of debt. We've got into more debt in the last decade than we have in the entire previous history of this country because of all the printing of the money. Well, the Federal Reserve is trying to unwind that. So now what they've been doing is they've been selling that debt back. So when they sell the bonds back, they get the cash back. They take the cash out of the system, and they're trying to reduce the federal deficit and the balance sheet. That's what they're trying to do. So the reality is they've been trying to do this, and they've been doing it successfully for a little while. But Wednesday, last week, they announced that they're going to quit. They're going to quit this. I think they said as of August, if I remember, maybe September at the end of this year, they're going to quit selling debt. So it's a double whammy. Why would they quit selling this debt and quit unwinding the debt? And why would they stop raising interest rates? Well, those are two good questions that no one can seem to answer. And I think there's two reasons why it could be. We're going to come back to that in a second. But let's talk about the effect that it has. And the effect that it has is short-term interest rates have stayed the same. And long-term interest rates now have gone even just a little bit below short-term interest rates like we talked about a minute ago. So why would someone, let's answer that question, why would someone buy a 10-year treasury bond at 2.41 when they can get a 3-month bond at 2.45? Why would they do that? Answer, because they think that the 2.41 for 10 years is the best they're going to get over the next 10 years. They expect short-term rates to come down below the 2.41. They don't expect the 2.41 to go back up. They expect the short-term rates to come down. And the only reason short-term rates are going to come down is if the stock market starts to have some problem. So people are willing to invest for 10 years at 2.41 because they're forward looking. They think that if they wait a little bit, maybe that 2.41 will go lower. Maybe the 2.5 that the short-term rate is now, the 2.45 on the 3-month, maybe that's going to go lower. And so they'd rather lock in 2.41 for 10 months than invest 2.45 for 3 months. And then in 3 months when that bond matures, now all of a sudden they can't even get 2.41 anymore because both of these would have come down. This is their thinking. So they're willing to lock in a lower rate for a longer term so that if interest rates do go back to their lowest levels, which is almost zero, then at least they're getting 2.41, whereas maybe the 30-year is paying less than 2, like it has been many times in the last decade. So that's why investors are willing to lock in. Now, why would short-term interest rates be lowered? Well, the Federal Reserve controls short-term interest rates, right? And in good times, they raise them, and in bad times, what do? They lower them. So if the stock market starts to have some problem and they lower these short-term interest rates, well, then the reality is that that's going to have an effect on long-term interest rates. So no matter how you slice it and dice it, the Federal Reserve is signaling that the economy is not in great shape. And by making this move, by essentially keeping the short-term rates where they are and discontinuing the sale of bonds back to the banks and by stopping the unwinding of the quantitative easing that they've done, by doing this, the Federal Reserve lowered the long-term interest rate indirectly. And that's exactly what they've done. Now, no one knows why they did it. Now, there's a lot of smart guys over at the Fed. I mean, these are the guys that should know as much about money as anyone else in the country. They certainly know that if they stop selling bonds back to the marketplace and they stop unwinding the QE, they know that that's going to cause long-term interest rates to go down. They know that that's going to happen. They know that long-term interest rates going down is a sign of a recession and virtually certain to cause a recession. They know that. So why are they doing it? You know, there's a lot of guys that have good textbook knowledge that don't have a lot of common sense. And I've heard this from people that I've read and people that I've studied in some of the commentaries that I've read over the weekend about some of these things that happen, and that's come up. Maybe there's just not common sense, and that could be. It could be that the stock market spooked them November, December, and they just don't want to deal with it. Could be. I don't know. Another thing that it could be though is that maybe they want a recession. You know, and I'm not a conspiracist. I don't want you to think that I am. I'm not. But you know, it probably is not a secret to any of you that there's a lot of people out there that don't like Trump. So the reality is you know, we're coming up on election time here. Another couple of years or so, right? And you know, one of the things that's going to help Trump get elected or not get elected is the status of the economy. So if the economy goes into recession a year or two before Trump has his election again, maybe, I mean, that would hurt them for sure. It's not maybe, that would definitely hurt them. So you have to wonder whether or not there's politics behind the scenes that are, driving this as well too. Hey, think about it. We've had the longest bull market, the longest cyclical bull market this country's ever seen. Crossed over in August. We know nothing goes up forever. We know that we're due for a recession anyway. So is the Fed really thinking that, instead of trying to delay the recession like we've been doing for all these years, instead of trying to delay the inevitable recession until after Trump's election, maybe we cause a recession? And when you look at the history of recessions, most of the recessions are Fed driven anyway. So it could be. And I find it interesting that, and again, it's not a political video and everyone has their own views and I'm just giving you my thoughts, but I did find it interesting that whole Robert Mueller, that whole thing with, with trying to get Trump and so on, that whole thing just kind of blew up in everybody's face. And in some regards, I think Trump felt exonerated. I mean, he certainly did. Whether it's true or not, I don't know. We'll find out later. But that happened last week, and then the Federal Reserve made this move last week as well too. So my first thought, and I don't know if it's valid, I'm not a conspiracy theorist at all, but my first thought was interesting. They couldn't get him with Robert Mueller, so are they now going to get him with the recession? I don't know. It's just a thought that I had. So I'm hoping at least this explanation of yield curve helps you a little bit, maybe gives you some food for thought. The Federal Reserve's move virtually made it clear that there's going to be a recession, and that's something that has been well versed. If you were just to Google it and start reading on that, you're going to see that. Made it clear. Now the reality is that the stock market doesn't respond to the bond market for sometimes 3 or 6 months. So it could be 3 or 6 months before this happens. It could be a year before this happens. So it's not something that is going to happen today or tomorrow, or we don't know for sure. But it's not likely. They say that the bond market is smarter than the stock market, and the bond market is often a future predictor of the stock market. And I think the bond market now is predicting a recession. Now, what could change about that? Well, the yield curve's only been down for 2 days at this point, and they do look at the average. And there have been times before that the yield curve's come down and then it's come back. And so it could come back. It's possible that it could come back, and everything we're talking about here just doesn't wind up holding true. That's possible, but I don't see anything changing. There's just nothing on the horizon that is changing that's going to cause that yield curve to go back up again. There's just nothing there that's causing that. So that's the concern. So if you're a client of ours, bottom line, you don't have anything to worry about. You're invested for income. Matter of fact, the flat yield curve for you is good. Interest rates going up are generally not good for income producing portfolios with the different investments that we have you in. So overall, a lot of our clients' portfolios fluctuated down 3, 4, 5% over the last year or two. But then at the first part of this year, really in January, matter of fact, almost all your portfolios fluctuated back to where they were before. Why? Because the Federal Reserve announced that they're not going to be doing as much quantitative easing, and now just last week they announced that they're not going to do any quantitative easing. They're not going to, I shouldn't say quantitative easing, they're not going to be raising the interest rates anymore. And as a matter of fact, they're going to quit selling debt and reducing the balance. They're going to stop that early this week. So bottom line is that's good for your portfolios. Your income is going to remain consistent regardless of the fluctuation. So you're still going to fluctuate, but as long as you're living off the interest or reinvesting the dividends and interest, then you're in great shape. So it won't affect you at all any more than anything else has, as long as you've been with us. But if you're in the stock, and the market went down 20% in December, worst December on history, and now you've all gotten it back. Right? And we've had a lot of clients that wanted to become clients in November and December that are just waiting for a better time, waiting to get it back. Well, you've gotten it back. This may be the best time you have to decide to take some chips off the table and reinvest it elsewhere. So if you're not a client of ours and you're concerned about some of the things we've talked about, and you want to know where else do we do it, where am I putting my clients' money to be able to generate a decent rate of return that's not affected by all this, then like I said, call us and we'll be more than happy to schedule a quick call with me, and we'll talk to you about it. So, and if you are a client of mine, we do have a number of clients that still want to have their hand in the stock market. A lot of you have 10 or 15 or 20% of your money in the market, gambling, just because you can afford to do that. Well, what I can't do is I can't call all of you and say, hey, is this time you want to take some chips off the table? But if you are a client of ours and you've got money in the stock market, it may not be a bad idea to take some of those chips off the table and wait to reinvest that money at a better time. So those are my thoughts. Wanted to share that with you. Had no intention of this being 20 minutes, but I have a hard time saying anything in less than 20 minutes, and I really hope it's been valuable and beneficial. Thank you for your business. Thank you for your trust. Call me if you have any questions or if you want to take some of your chips off the table. Look forward to hearing